So when we're talking about a seller looking to exit, it's not necessarily a seller wants to exit because they just don't ever want to work. We're looking at it in terms of, can the business operationally run with the right commercial roles in it, with the right sales and the right margins to cover those roles and the right cash flow? That will be how, when you go to market and you want 6 times your EBITDA, that is how you'll get it. Hi, and welcome to the Build and Exit podcast. I'm Julie Wilkinson, and I'm your host. Today, I wanted to talk about adjusted EBITDAs, what it actually means, how it's impacting sellers and buyers, but also what should business owners be thinking about as they're scaling if they're looking to maximize their value and exit, and how the adjusted EBITDA will actually impact them. So to take it back to basics, I don't know if people actually know what EBITDA, the official terminology. So it stands for earnings before interest, tax, depreciation, and amortization. It's a fancy name for a profit, net profit. It is the same, similar thing. It's just a terminology. And the reason it's called that is because it effectively looks at operating profit versus things that are outside of day-to-day control. And usually that's used in businesses, especially sort of more in corporate businesses, because it's a way that people can track how operational teams have performed. So where people on things like bonuses or they're financially rewarded for their performance, there are elements of the business, sort of things like depreciation, interest, amortization, that day-to-day employees don't have any control over, because that's decisions more at top level. So things like, what funding have you got? What assets have you built? Or what financial standards are you using, which is more driven by finance. So EBITDA comes from the terms of effectively operating profit, of what profits are controlled by sort of day-to-day management and employees of the business. So we then look at EBITDA in terms of what does adjusted EBITDA mean? So adjusted EBITDA is then an adjustment to the book EBITDA. So the book EBITDA is your system profit. So that's what goes through your financial systems, and all of your depreciation, everything gets posted through like month end or through banking or whatever, however the transaction goes in. Adjusted EBITDA is then effectively a mechanism to adjust the book profit. So the book earnings before interest, tax, depreciation, and amortization. So that it allows for one-off costs. So they're one-off scenarios that do not consistently happen. That's what adjusted EBITDA should be used for. But obviously in sort of smaller SMEs, adjustments are often coming in because owners are making decisions in that business where, if they were paying third parties, may go to the profit and loss. They'll actually, how they're paying themselves is going to the balance sheet as dividends. So in a corporate business, adjusted EBITDA, these types of, so how sort of smaller SMEs operate don't tend to happen in corporate businesses. You know, everybody's on payrolls, and even directors and things are generally on proper salaries, and everything goes through a profit and loss. So traditionally in corporate businesses, adjusted EBITDA would be used for one-off transactions that are adjusting for one-off costs or income that are going through that aren't going to happen, aren't going to materialize again. And so they're impacting the profits in 1 year because of something that's happened. In SMEs and more entrepreneurs and smaller businesses, we're finding obviously the adjustment is also moving into how they're day-to-day operating the business, because there are decisions that they're making that are impacting their profit and loss. Whether they know or not is another question, but that is typically what's happening. So when it comes to selling a business, so obviously the buyer's looking at it from their perspective, the seller's looking at it from their perspective, adjusted EBITDAs are often being done on valuation. It can be because of one-off cost of transactions, but I think typically people are doing it because they're looking at what's the real profit and what's my business worth. And the conflict you get is obviously a buyer's coming in and want the best deal for them, the seller's trying to get the best deal for them, and ultimately sometimes there's a conflict arising because people are challenging the adjustments that are made. And I believe that this is happening because, you know, there's a lot of bad press out there about brokers. Everybody blames the broker, or the broker's trying to adjust it because they're trying to get the seller to think it's worth more than they want. But if you actually take a bit of a step back in terms of how has the seller operated their business, fundamentally adjusted EBITDAs, if you're running your business operationally savvy, you should understand your adjustments as you're going along anyway. And therefore, when you come to sell the business, if you had the right financial support and the right understanding of your accounts and your business model and your operations, you wouldn't be relying on a third-party broker to adjust it, because it would just be something that's naturally happening as part of what your month end or quarter end, or even if it was a year end adjustment, depending on the size and the complexity of the business and the need. So adjustments are valid, and it all comes down to the accruals concept. So a lot of SME accruals concept is used massively in corporate businesses. There's a lot of bad press about it. A lot of SMEs sort of challenge it and say, oh, it's just a way to manipulate accounts. Actually, the truth be told, you can't run an accurate set of accounts without using the accruals concept. So let me just explain what the accruals concept is. So the accruals concept is, in principle, matching income with costs. The reason you do that is because there are things that happen day to day in your business where, when you pay for things in money, doesn't always materialize when you get the profit, the income or the costs. So income and costs obviously end up equaling profit. So the accruals concept allows a mechanism for you to match those two things so that your profits stabilize and show consistent profits across monthly, quarterly, yearly, and over periods of years as well, if you've never sort of used this mechanism. A basic example of that would be you have a project where you've quoted a customer. Let's just say you've quoted a customer £50,000 for a project. You're going to run that project over 3 months. You're running the project over 3 months, and you're going to invoice that customer all up front. They're going to pay you at the start. So that's great. That's great for your cash flow, because you're doing that and they're happy to pay you. So they've paid you 50,000 up front, and that's secured that contract. But now something's going to happen. Now, first and foremost, what are your terms in that contract? So if you didn't deliver, can the customer claw back 25%? So if they've given you £50,000 up front, but there's still a risk that they could claim back 25%, how would you know? How would you account for that 25%? So how do you think, I have got a risk to my cash flow, what would happen if I had to pay that 25% back? So this is where the accruals concept starts coming in, because it would essentially say, should somewhere in your financial account, so in your month end, when you get that money from the customer, should you account or have somewhere a visibility 25% of that 50,000? Because now, let's say if you're doing one project, that's probably quite easy for you to keep track of. But let's just say you're doing 10 of these a month. Maybe they're all different values. So maybe you've got a 50,000, a 5,000, a 1,000, a 3,000. You could theoretically have £100,000 where people are paying you up front, and all of these customers could claim back 25% on a warranty basis if something went wrong. So now let's just say you've got 25 projects. Now, one project you might be able to track, 5 of them maybe not, and they could all fall at different times. So you could be looking, it might be it's 14 days, it might be it's 30 days, it might be it's monthly. And obviously the more complex the contracts, the harder it is to track. So this would be where we'd be looking at, okay, so when we're looking at financial standards and accruals concept and how people are reporting, we're looking at, okay, how would you track all of those 25% deposits? So that's the first thing, is how would you know you've got a risk to your cash flow? Because that's what it is. You know, if you had lots of these projects and something did go wrong and someone clawed back the money, would you actually have the cash flow to pay them? 2 terms in your engagement. So then, but then you start looking at, okay, how are you then going to run this project? So perhaps you've got some employees, perhaps you have to use some contractors. So now you've probably raised a sales invoice with the VAT to the customer for the full 50,000. Now you've got to fulfill that project. So in that month, when you raise the invoice, is that actually a sale? So a lot of people are transacting on what they call cash accounting. So you would, because you've paid that 50,000, you're putting that 50,000 to your profit and loss. But is it actually a profit? Because again, if something went wrong with that project and you had to claw back 25%, eventually if you did give a refund, it would then go into as a cost and reduce the profit. So the accruals concept would be thinking about, well, where should I report this £50,000 in my accounts? And then how do I release that £50,000 as I go along the project? Because at the end of the project, you're going to have a net margin. You're going to have £50,000 that you've raised to the customer, costs to run that project. Costs to run that project could be fixed employees or it could be contractors. Those two scenarios are different. So fixed employees, you typically, you're obviously paying on payroll at the end of each month. Contractors are often invoicing you. So let's say you use a mix. Let's say for this 50,000 project, you've got one employee, but you're going to use one contractor. So the one employee is going to get paid every single month, and you're running this project across 3 months. So for 3 months, they're going to get paid. So now you've got this £50,000 sale and you've got this employee, 3 months wages. How do you allocate that wage against that 50K? Because this employee could also be working on multiple projects. So let's say this one employee is working on 5 projects every month. How do you know how much of their time is then going across that 50,000. So there's time mechanisms in terms of perhaps you've got a time management system, but then how is that time recorded against the actual project? Now you've got a contractor. So you come to the end of the month. Let's just say the contractor's done 30 hours. The contractor invoices you on the 5th the following month. So you've now got a £50,000 sale that you've invoiced up front. Probably should be sitting on the balance sheet with a release mechanism. So you release it evenly. So you do 1/3 of it each month and you release that 50,000 to the P&L each month, 50,000. You now have an employee that's worked on multiple projects. So in your P&L, you'll have one number as that cost, but how do you then split that across the project? Now you have this contractor that's worked on one specific project, or perhaps the contractor's worked on multiple projects and their one invoice is not going to split the projects. Now you've got to work out, but they're not going to invoice you until the 5th of the following month. So then if they're not going to invoice you until the 5th of the following month, that means if you just use based on when you paid them, their invoice, their cost would go into the following month. But that would mean if you did that every month of that project, the first month of the project, you would have no subcontractor costs, even though you might have reported the sale. The second month, you'd have their cost. The third month, you'd have their cost. And then the following month, on the 4th month, when the project's actually over, their last cost would go in. And this is what the accruals contract, it would say. It doesn't matter when people invoice you and it doesn't matter when you invoice the customer. You should be looking at the mechanisms behind those transactions and moving those transactions into the right month so that your profits. And because this is why when it comes down to your profit and losses and you're starting to look to sell and buyers are coming in, fluctuations in profit percentages. I'm often seeing monthly, when you run trial balances monthly, you've got gross profits. One month they're at 15% margin, the next month they're at 65% margin, the next month they're at 30%. The fundamental reason why that's happening is because it's not because because realistically you would probably not running your business like that. Like all of your services or products are probably trading at a relatively standardized margin, or you're trying to, unless something goes wrong. But the reason your financials don't stack up to what you actually think your project should be doing is because you're getting income and costs, money coming in, cash coming in and out at all different times. And if you don't have any systemization or methodology to then transact those transactions into the right month, then that's when you're going to get the issues. So that's where the accruals contract comes in. And I believe that has a massive impact on adjusted EBITDAs, because adjusted EBITDAs can only ever be right in the first place if your fundamental profit, costs, and your sales, your costs and your profit are right in the first place. Because adjustments should be done after you've actualized your accounts. So if you haven't got actual accounts in the first place, then adjusted EBITDAs can make them even wrong, because you might be adjusting the wrong things in the first place, not having the right visibility. So looking at balance sheet items, are they assets or liabilities? So obviously in the scenario of the 50k sales, when that person gives you the money, you might have the cash in the bank, brilliant, so it's an asset. The question is it really your asset? Is it your asset right then? Is it your asset to keep forever? Or if there's a risk to that asset, then you have to start thinking, when should it go to the profit and loss? Like, when is it my sale? When is it my cost? So it's really important to understand financial concepts when you're also looking at adjusted EBITDAs, because obviously the adjustments will come off the back of what's gone into the profit and loss in the first place. So that's the adjusted EBITDA. Now, the one-off costs come from, let's just say you've done all these projects and you're always taking 100% cash up front. And let's say you did one big project and it went massively wrong. And the customer sued you and you went to litigation and maybe you spent £50,000 on the solicitor bill. Now that £50,000 of the solicitor's bill to cover some of these really high value costs have gone to your P&L, but that will obviously be lowering your profits for that year. And the question would be, well, first of all, if a buyer came in at that point when this has happened, they'd probably be saying to you, well, how did it happen? How did that go so wrong? Now, look, everything happens. People can make mistakes and there can be one-off scenarios. And so the first thing you'd be looking at showing is it happened because of this. We know why it's happened. We've tightened our controls. It's 95% never likely to happen again, but it did. And as a result, it's cost us £50,000 to £70,000 to sort out. Maybe you've had to give some refunds, you've had solicitor bills, whatever it may be. Now that's going to be likely to be a cost in your P&L and drop in your profits. You start looking at, so when you then came to adjusted EBITDA, you would be rightly to say, well, I've had a £70,000 cost this year. That's a one-off because I don't expect it to happen again. It's very unlikely it will ever happen again. And when we're looking at balance sheets like assets and liabilities, we have two terminologies. We have probable and possible. Probable is it's likely to happen again. Possible is it could, but it's not, because they're quite fundamental terminologies when we're looking at finance in terms of where things sit in the profit and loss and the balance sheet. So that's where an adjusted EBITDA could happen in terms of general trade. And that's why it all aligns to the overall process you're following in terms of your income and your costs in the first place. Because if you look at that end-to-end process, first of all, your terms, you've had a really good contract with a customer, you've got loads of money up front, you're managing your projects, and then you know how you're going to manage that should something happen at the back end, and how you're managing your cash and your profits. But then we have adjusted EBITDAs when we look at sort of day to day with entrepreneurs and SMEs. We've then got to look at, okay, so how do then owners transact daily or monthly across the year that then also impact their EBITDAs? The biggest ones is dividends. So just back to principles, when an owner, an owner is a limited, often the problem arises because an owner just sees their limited company as theirs. The truth is, in the eyes of HMRC and sort of, legalities of a company, a limited company is actually a legal entity in its own right. So the owner is a director of that company and a shareholder, but that limited company in its own right is its legal entity and it has its own bank account. And I think a lot of people get misled because the owner just thinks, oh, it's my company, it's my money, I can just take the money. Well, that's not technically true in legal terms. So what happens is normally owners go in on lower salary to meet the national insurance threshold so that they qualify for government pension and they pay lower tax, which obviously changes every year in terms of tax rules and what the thresholds are. And then they tend to just take their money on a consistent basis, whether that be whenever or monthly or quarterly or however they take it. And then they declare that's dividends. When you first draw down that money, it's actually a loan. It's actually a director's loan. And the reason it's a loan is because you've taken money interest and tax free. The truth be told, nobody out there can often go and just get access to money where you don't pay either interest or tax on it up front. So if you were in a third party company and you're on payroll, all your taxes would be taken every month. The reason you're taking the money out, now you may think you're being advised by your accountant to do it, but the truth behind it is the reason you're doing that is because the tax rates on dividends are more beneficial than the tax rate in income tax, which is fine. There's nothing wrong with it. The question is, are you in control of it? And do you know how that impacts the longer term value of your business? So you're taking all of your money out, but you're working 60 hours a week. Nothing wrong. If you're building a business, we all know you have to work hard. But what roles are you doing? Because what's happening is people are doing this for years on end, always taking their money in tax efficient ways, never really looking at how is that impacting their profits. Let's just say you're trading at a 25% net margin, but you're paying yourself £60,000 a year and you're doing 60 hours a week. So the first thing to think about is what roles are you doing? And looked at a commercial role for the role you're doing. The truth is owners are generally doing bits of all roles. They're doing a bit of sales because they're bringing in clients. They're doing a bit of operations because they're overseeing staff and they're fixing problems. They're doing a bit of finance because they haven't got the right setup. So they're running their own cash flows and they're paying suppliers. They're then probably doing bits of health and safety. You're looking at all of your policies, making sure you're looking at your legal, making sure you're not going to have any massive sues or any legal issues because of how you're running the business. So the truth is owners are doing lots of little bits of every business, lots of different roles. And the reason that's happening is because it's not cost effective for them to bring in employees to cover all of those staff. And that's why a lot of people are using contractors. However, so there is nothing wrong with doing it, but there is a fundamental flaw in terms of if you go to market to sell, a new buyer coming in to buy that business isn't going to want to do lots of those little jobs. And the truth is, at your current 25% margin, you don't have enough margin or budget allowable for that person to bring in those roles because you haven't been able to do it as the owner now. So why would a buyer be able to do it? So what you've got to look at across growing your business is how do you build roles, contractors, employees and staff, and make enough margins to cover all of those roles so that when you do eventually sell and you're at a 25% margin, that 25% margin actually covers the budgets for your job. So when we're talking about a seller looking to exit, it's not necessarily a seller wants to exit because they just don't ever want to work. We're looking at it in terms of, can the business operationally run with the right commercial roles in it, with the right sales and the right margins to cover those roles and the right cash flow? That will be how, when you go to market and you want 6 times your EBITDA, that is how you'll get it. Because when you're at a point that your business runs and it doesn't rely on you, it might be you still choose to work in it. The question is, are you paying yourself the commercial role? So we go back to the dividends. You're taking the money out. It's actually a loan, and it becomes a dividend when you declare it on your self-assessment. But you are doing multiple roles in that business, and none of that money is going to your profit and loss. So none of it's going. So it's not actually in your margin. So it's not in your 25% margin. And you haven't really ever written a job role for yourself. So you haven't written a job role, because if you did write a job role, you haven't really got a job. You're firefighting across multiple different stages of a business, fixing problems, doing little bits, keeping the business running, telling yourself, oh, it's what every owner does because it's what has to be done. It's hard to run a business. Well, it is hard to run a business, and there is nothing wrong with getting involved in those things. The question will always become, have you got a strategy to get out of it, or haven't you? So your adjusted EBITDA, the reason people are adjusting for owner salaries, often the owner's saying when they go to market, and this is where I think then the sellers are getting bad advice. Sellers are going to market going, oh, well, the dividends are irrelevant because they don't go to the profit and loss, so you can just exclude them. It's actually the complete reverse. Usually the dividends are massively important, and you've actually overstated your profits because you're working 60 hours a week with no job role, with no job spec. And for multiple years, which is the 3 years your business has been valued on, you've never actually accounted for any adjustments in your profits to account for the role that you're doing. And this then means sometimes there is a fundamental flaw of how people are quoting sales. Because if you were going to look at the role you're doing and start putting commercial salaries on them, the truth is you could be looking at 60 to 100 grand a year job in multiple roles, even if that's contracting basis. So therefore, the 25% you're currently making is starting to be distorted because you haven't got the roles. And then a lot of people just think, oh, well, I can't afford those roles, so I'll just carry on. If you can't afford all of the roles to run your business, then there is a fundamental pricing issue right at the start. Because that means what you're charging your customers. You may have a quoting tool. That looks at all your materials, that looks at all of your contractors, that look at your staff. But if it doesn't include you and your time and all these bits that you're doing, then perhaps the pricing tool has a flaw in it, because maybe these sales prices need to go higher. And that can be quite scary for someone, because it actually means maybe you need to go right back to basics now and start looking at, oh God, what am I charging my customers? Are my pricing right? And this is where I believe, business owners go on a journey. You're always having to constantly review your pricing, you're having to constantly reduce your costs. But a lot of people will just start cutting costs. If their profits are going down or they're having a bad time, they'll start cutting costs. But actually, that might not be the right thing. It might be you have to go basics, look at your whole operational model and your whole pricing structure and how you accounting for things. So this is where business and operations aligns very closely to finance. All of these things I've talked about today is where financial decisions in terms of how do you track cash, costs, and your profits and how you're moving money actually impact your profit and loss. But your profit and loss is impacted by your operations, because your operations are ultimately decided by the decisions you're making day to day in the business. And that is why when businesses start hitting 7 figures and plus, the finance setup is so crucial, because the bookkeeper that you had when you launched a business 10 years ago that just took the invoices that you paid and put them, the business model complexity massively changes, and you need a whole different structure, because you need financial skills that are going to help guide you on making key decisions, not because you need the person there to make the key decisions to run the business. You're a great owner, you're a great entrepreneur, you know how to run a business and you know how to get the customers, and you know exactly what you do and why you built the business. But what you might not know is these decisions I'm making, are they the right decisions for me to maximize my own wealth, keep my profits consistent, and actually keep my cash flow, make sure my cash flow is correct in case of all the risks that might appear in my business. And that's where businesses change mechanically between how they first operate and then how they start operating as the business grows and gets more complicated. And that is why I've I've set up my consultancies where I help people with finance assessments, where we look at the financial setup of the business. We look at what's the bottlenecks, what's the constraints, and what is the team structure that you've got in place to make sure that you have the right setup in place so that you can start tracking all of these things. So my 3 key takeaways on adjusted EBITDAs is they are relevant and they shouldn't only be used at the point you want to sell your business. You should be using your finance teams now to look at, if I was just going to do an adjusted EBITDA for this financial year, what would it show? If you do not have anyone to help you with that, and you can't get it quickly because somebody's saying to you, oh, I'll come back to you in 6 months when I do the year end, isn't quick. So if you haven't got anyone to help you with that, then you have got a risk that you haven't got the right setup. What accruals concepts are you using and how do you track your cash flow? So going back to the sales decision, when you're doing things with customers and money's coming in and money's going out, do you really understand how those decisions impact your profit and your cash longer term? If you don't, then you may need some support. And the third thing is that you as the owner, how you're running the business, especially in terms of your pricing things in general, but also what you do in the business has a massive impact on your profits and your operations in terms of the value of that business longer term. And if you don't really know, it's one thing taking the money. You might know how much you pay yourself, or maybe you don't know how much you pay yourself and you find out at the end of year. So there's one thing paying yourself, and perhaps you've got enough money to pay yourself. There's nothing wrong with that. And maybe you're paying yourself more than a commercial role. The question is, do you actually know? So if you don't know those 3 things, then there is a risk that at the minute that the business has grown outside of where it was when you started it, and you may need more support. But these are the things that when buyers come in and start challenging the valuation, this is the reason why. So what I'm advising people not to do is just go to market, go to brokers, suddenly think they can get a valuation their business will be worth, because it might not even be worth 3x. Because if you've got poor operations, could be nobody wants to buy your job. And this is a real shame, because people have spent years building their businesses and have really good businesses, and with some tweaks and some changes, you just need some help to get it to a place where it can operationally run so you do get the value that you deserve. So just want to say thanks for all my listeners. If you loved the episode, hit the subscribe button or leave us a rating and review on Apple so more people can find the channel. Any questions, feel free to comment on the podcast, and I look forward to seeing you soon.